Imagine if you could unlock the wisdom of a legendary investor with a lifetime of experience in just 30 minutes. Howard Marks, the co-founder of Oaktree Capital, isn't just any investor. He's a master of the craft. His secret? It's not about finding the best stocks. It's about understanding what they're really worth. What if the secret to successful investing isn't about following trends, but about doing the exact opposite of what everyone else does? Are you ready to challenge everything you know about investing? In this video, we'll break down Howard Marks's legendary principles. You'll learn why buying undervalued assets is just the beginning, why controlling your risk is as important as growing your wealth, and how avoiding common mistakes can often be the key to winning in the investment game. Get ready to unlock 78 years of wisdom from one of the greatest minds in finance. Stick with us, and you'll walk away with insights that could change the way you think about investing forever. Core principles of Howard Marks's philosophy: buying below intrinsic value. Howard Marks's first principle for successful investing is simple: buy below intrinsic value. But what exactly is intrinsic value? Intrinsic value is the true worth of an asset based on its fundamentals, its cash flow, revenue, assets, and future potential. Marks believes that buying at or below this intrinsic value creates a built-in margin of safety, protecting investors from overpaying. But if intrinsic value is the key, why do so many investors ignore it? Why do they chase rising stocks without ever questioning what they're actually worth? Imagine two investors. One buys a hot stock everyone is talking about, while the other takes time to analyze its intrinsic value. The second investor, the one with discipline, stands a much better chance of protecting their investment from drastic losses. Risk control. Marks's second principle is just as important: controlling risk. He said that managing risk isn't just part of investing, it's the most important part. Risk control means knowing how much risk you're taking on, then building strategies to protect yourself. For Marks, this includes diversification, understanding market cycles, and always maintaining a margin of safety. As Marks puts it, in investing, it's not about how much you make, but how much you don't lose. During crises, investors who control their risk avoid catastrophic losses. They understand that long-term success isn't about chasing high returns, it's about surviving downturns. Investing as a contrarian. Marks's third principle is to think like a contrarian. Instead of following the crowd, Marks advocates for an opposite approach: buy when others are fearful and be cautious when others are greedy. Consider the dot-com bubble or the 2008 crisis. While most investors were chasing hot tech stocks or housing, contrarians saw danger signs and stayed cautious. Marks argues that true opportunities appear when most people are afraid. Being a contrarian isn't easy. It requires discipline and confidence. But as Marks says, the best investments are often the hardest to make. Avoiding common mistakes. Howard Marks believes that investing isn't always about hitting big wins. Sometimes it's about avoiding costly mistakes. He refers to a concept called the loser's game, popularized by Charlie Ellis. In amateur tennis, the winner isn't the one making spectacular plays. The winner is the player who makes the fewest mistakes. The same principle, Marks says, applies to investing. Common mistake. #1. Following the crowd. One of the biggest mistakes investors make is following the crowd. During the 2008 crisis, many people sold in a panic, only to miss the recovery when the market rebounded. Marks calls this the danger of herd mentality. Instead of following the crowd, successful investors think independently. They look beyond market hype and base their decisions on facts, not fear. Marks urges us to remember, when everyone thinks alike, nobody is thinking. Common mistake #2. Overconfidence. Another common mistake is overconfidence. It's easy to feel invincible during a market boom, but as Marks warns, overconfidence often blinds us to real risks. Or else, confidence can lead to carelessness, says Marks. Overestimating your own knowledge is a fast track to losses. History is filled with stories of overconfident investors losing fortunes when reality hit. For Marx, humility is key, understanding that no one can predict the market perfectly. Common mistake. Hash 3. Ignoring risk. Many investors make the mistake of focusing only on potential returns while ignoring the risks involved. But as Marx teaches, managing risk is just as critical as making profits. Investing isn't about chasing gains without considering what you could lose. Marx urges us to remember that protecting your capital should always come first. As he says, the road to long-term success is paved by caution, not greed. Common mistake. Hash 4. Short-term thinking. Finally, there's the trap of short-term thinking. Many investors obsess over daily price changes and short-term gains, but Marx believes true wealth is built over years, not days. Just like a tree needs time to grow, investments need time to mature. Marx encourages us to take the long view and focus on the steady growth of our wealth. To succeed in investing, it's not just about picking winners, it's about avoiding costly mistakes. Remember these lessons, and you'll already be far ahead of most investors. Embracing patience and long-term thinking. Howard Marks believes that one of the greatest secrets to investment success is patience. In his words, the path to lasting wealth is a marathon, not a sprint. While most investors get caught up in daily price changes, those who stay focused on the bigger picture reap the real rewards. The power of compound growth. One of the strongest arguments for patience in investing is the power of compound growth. Marx emphasizes that wealth accumulates by reinvesting returns, allowing your money to grow exponentially over time. Think of compounding like planting a tree. With time, a small seed grows into something solid and lasting. Investing works the same way. The longer you nurture it, the greater it becomes. Marx reminds us that while quick gains are appealing, true wealth comes from letting investments mature over time. The difference between short-term and long-term returns can be staggering. Why patience matters. During market volatility, markets are volatile by nature. Prices rise and fall, sometimes drastically, but as Marx emphasizes, patience is what separates successful investors from the rest. Marx believes that during times of market chaos, those who stay patient and hold their positions are often rewarded. They know that market fluctuations are temporary, but the gains of a well-chosen investment can last a lifetime. Avoiding the temptation of short-term gains. Marx warns that chasing short-term profits can often lead to disappointment. Those who chase immediate rewards may find themselves on a roller coaster of temporary highs and deep lows. Instead of trying to time the market, Marx advises us to give our investments time to grow. A steady, long-term approach is often the surest path to meaningful returns. The wisdom of long-term patience. In the words of Howard Marks, patience is essential for any long-term investor. This principle is what guides successful investors to stay focused, even when markets shift. For Marx, long-term success in investing doesn't come from quick trades or speculative bets. It's the result of years of discipline, patience, and the wisdom to wait. Remember, the journey to wealth is a long one, but the rewards are worth it. The summary of Marx's timeless lessons, the essence of Marx's investment philosophy. Howard Marks has spent decades studying the patterns of success and failure in investing. Here are his most timeless lessons, insights that any investor can apply no matter the market conditions. Buy value, not hype. Marx's first principle is clear: focus on value over hype. Rather than chasing the latest trend, he suggests that the best investments are often the most undervalued, not the most popular. Buying something for less than it's truly worth is the essence of value investing. While the crowd may be chasing hot stocks, those who seek undervalued assets can find real, lasting success. Lesson number 2, control your risks. Marx emphasizes that smart investing isn't just about the potential for gain, it's about the ability to protect yourself from loss. He stresses the importance of managing risk as the foundation of all sound investing. An investor who manages risk carefully can weather market downturns with far less pain. According to Marx, it's not about avoiding risk entirely, but controlling it intelligently. Lesson number 3. Think independently. Howard Marks is a strong advocate of independent thinking. When most investors are optimistic, he urges caution. When they're pessimistic, he sees opportunity. Thinking for yourself is essential for avoiding the herd mentality. Being a contrarian doesn't mean going against the crowd for its own sake. It means making informed, independent decisions based on facts, not emotions. Lesson number 4. Avoid costly mistakes. For Marx, the road to success isn't paved with constant winning, but by avoiding big mistakes. He teaches that investing is often a game of survival, where avoiding losses can be more important than pursuing gains. Just like in amateur tennis, where success often comes from minimizing errors, successful investing is about avoiding major pitfalls that can ruin long-term growth. Lesson number 5. Embrace patience and long-term thinking. Marx's final lesson is perhaps his most powerful. Embrace patience and long-term thinking. He reminds us that the best investments often require time to reach their full potential. Success doesn't happen overnight. By staying patient and allowing your investments to mature, you set yourself up for real, sustainable wealth over the years. Timeless wisdom for any investor. These principles are timeless, practical, and universal. Whether you're a seasoned investor or just starting out, Howard Marks's lessons can guide you to smarter, more resilient investing. Remember, wealth isn't just about finding great investments. It's about developing the discipline, patience, and perspective to make them work for you. Final reflection on Howard Marks's wisdom. As we conclude this journey through Howard Marks's timeless insights, let's remember that successful investing isn't about finding the next big thing. It's about discipline, patience, and thoughtful decision-making. Marx's wisdom reminds us that wealth is built steadily, not through chasing trends, but through thoughtful actions and long-term vision. If you found value in this video, don't forget to subscribe to USA Finance and Trends for more insights into smart investing, financial strategies, and tips for building wealth. We'd love to hear your thoughts. What's your biggest takeaway from Howard Marks's philosophy? Share it in the comments below, and let's keep the conversation going. Thank you for watching, and remember, successful investing starts with a mindset. Stay curious, stay patient, and we'll see you in the next video.